Welcome to the 2022 annual meetings Governor Talk series. My name is Alfred Kammer. I'm the director of the European Department, and I'm very happy to have with me Klaas, the governor of the Dutch Central Bank, to discuss a really hard-hitting topic, ECB policy between a rock and a hard place. Klaas has been president of the Dutch Central Bank since July 2011. He has served as the co-chair of the Financial Stability Board, and since December 2021, he is the chair of the Financial Stability Board. He's also member of the Governing Council and the General Council of the European Central Bank, member of the European Systemic Risk Board, member of the International Monetary Fund's Board of Governors, and a member of the Board of Directors of the Bank for International Settlements. And if this were not enough, Klaas is also a professor in monetary stability at the University of Amsterdam, and he holds an honorary professorship at the University of Groningen. He has published a variety of articles in leading Dutch and international journals in the fields of monetary and financial economics. So it is my great pleasure to have Klaas today with us, and I'm looking forward to an interesting discussion, including questions from you. And I start right away because we have so many things to discuss. In the September 22 press conference, President Lagarde noted that we were still far away from the interest rate level that is necessary to bring inflation down. Does that mean that we should reach that rate faster? Will we see more front-loading and aggressive hikes? Are they preferable? And what is your view on the neutral rate?
Well, there are lots of adjectives, of course, that one can use to describe monetary policy. I think we need to show resolve. That is pretty clear. I think the situation that we are in is unprecedented and has been unprecedented for many, many decades. Such high inflation rates, a slowing economy, tightening of financing conditions. But our primary concern is inflation. It's not only the level of inflation, 10% headline, almost 5% core, and core still on the increase. It is also the persistence of inflation that we worry a lot about. And that is why we sort of embarked on this journey of policy normalization and subsequent tightening from December 2021 onwards. Then we announced that we would put a gradual end to our net asset purchases, and after that start raising rates. We have continuously, during 2022, been accelerating this pace. So we accelerated the phasing out of net asset purchases in March. We did it again in April, in June, so that we could already hike rates in July. We hiked rates in July and September both times. We did more than was anticipated in the markets before the meeting. So yes, we have been working hard to get on top of the issues. At the same time, we cannot each time accelerate vis-a-vis what we did last time and what we have pronounced last time. For me, I mean, I have no indication that with steps up to 75 basis points, we would not be able to achieve our price stability mandate, 2% inflation over the medium term. So no to a continuous acceleration, but yes to that we absolutely need a few more of these significant interest rate steps before we come into the territory that I would describe as roughly neutral. Mm-hmm. I mean, neutral is, of course, very, very difficult to determine. You can use different models. It's also not completely insensitive to monetary policy, by the way. So to say that neutral is something, a sort of God-given stable value, that's probably also not true. So I'm always a bit careful not to try to suggest too much precision with respect to neutral. But I would say that we're not clearly far below neutral, and we need at least two of these these bigger hikes in the coming meetings before we could be able to say with a sufficient degree of comfort that we entered the zone where probably the neutral rate also resides. Let me put it like that.
Mm-hmm. Good, I think that was very clear. There is a consensus among forecasters that the euro area economy is heading for a sharp slowdown in 2023 with increased risk of recession, and that was our World Economic Outlook forecast. Inflation is also high, but more supply-driven than in the US. What is the right policy stance for the ECB in these circumstances? How should the ECB react if stagflation risks were to materialize?
Well, I think it's good, Alfred, that you also started this question with relating us a little bit to the United States, because it is important to keep in mind that this inflation, this wave of inflation, is a combination of positive demand and negative supply shock. But the combination is clearly different in the euro area than is the case in the US. So I think the demand component is clearly stronger behind the dynamics in US inflation, whereas in Europe we suffer a lot more from sort of the increase in energy prices in the wake of Russia's unjustifiable invasion into Ukraine. That doesn't say that we also don't have a healthy demand component to inflation. We came out of the pandemic much stronger than expected. Consumption, investment, exports, they all performed much better than we expected.
Which is a good thing.
Which is an absolute positive thing, which is the kind of positive story you want to have behind inflation. But at the same time, the incidence of negative supply shocks is clearly more dominant in Europe than in the US. And that means that I also think that the monetary policy response at the end of the day needs to be more measured. That probably the terminal rate, again, one of these measures that I try to stay a little bit away from because nobody really knows where it is, etc. But I would sort of dare to say that I think that the terminal rate in the EU or in the euro area is probably a bit lower than is the case than will be the case in the United States. Now, how far we will have to move into restrictive territory, that of course remains to be seen. And the degree of uncertainty is so large that for the moment we have chosen this sort of meeting by meeting approach. I just try to explain that I believe at least 2 hikes are needed to go to the zone where also neutral approximately will be. But that is not to say we should clearly not take for granted that we can allow ourselves to stop at neutral. I think we will have to move into restrictive territory, but it's also very difficult to say how far we will have to move into restrictive territory. And once we are there, by the way, then we should also have a more integral look at our toolbox and not only have a look at rates. At the end of the day, you want to affect, as monetary policymaker, the entire yield curve. And we have multiple instruments active that work on different segments of the yield curve. We still have the TLTROs that work on, let's say, the part 1 to 3 year of the yield curve. Then we have our asset purchase portfolio, which work on the longer end of the yield curve. And once we have completed, let's say, the path to normalization of our policy rate, it's pretty clear that then also the roll-off of our asset purchases should become part of our instrument mix. Not as much in terms of fine-tuning policy as the policy rate. I do believe that the policy rate will have to continue to be the main instrument of, let's say, marginal policy adjustment, the rate that responds to changes in the outlook, changes in projections, etc. But at the same time, we also have to work on decompressing the term premia again. Otherwise, we would have too flat a yield curve, which would pose all kinds of problems of itself and would actually impede the transmission of the tighter monetary policy stance to all corners and all obligors in the euro area.
Any lessons you take from the Bank of England and Fed in terms of dealing with the size of the balance sheet?
Well, I hope we can take more lessons from the Fed than from the Bank of England, let me put it. And one of the reasons why that hope is actually also a little bit substantiated is that the Bank of England has an atypical asset purchase portfolio because it has a portfolio that has a much longer duration compared to the US and the euro area. And why is that difference relevant? Well, because we, like the US, can probably wind down our portfolios by simply discontinuing reinvestment, by having a sort of smooth roll-off. Whereas in the UK, of course, the market knows that in order to wind down the portfolio, they have to actively sell, which is much more difficult in a jittery market. Well, why is the market jittery? That is because, of course, fiscal policy is seen to be at cross purposes with monetary policy and is also seen to take a little bit too much risk with debt sustainability. I hope that our fiscal authorities in the euro area will not repeat those mistakes. I hope that they have also noted carefully what happened in the United Kingdom. And I hope that in the euro area we will be able to stay away from a situation like this.
Good. Despite inflation reaching historical high levels, we have yet to see large second-round effects in the euro area. Are you concerned about a possible wage price spiral and or a de-anchoring of inflation expectations? And how much actually do you think can nominal wages adjust before you would worry about a wage price spiral?
Yeah. Well, that's also, again, a very rich question. Obviously, I'm paid to be worried about these things. So to say no to these questions, that would be quite impossible. But I do think that we agree, actually, also with the assessment of the staff, that there's not yet convincing signs of a wage price spiral already taking effect. What do we see? Of course, we do see higher wage settlements. We see stronger calls from workers to be compensated for the hit that they have to take on their purchasing power and on their real wages. So yes, wages are on the increase, and particularly if you look at the more sort of contemporaneous indicators of wage settlements, a lot of wage data that we have is massively backward looking. And the fact that only roughly 1/3 of all wage agreement comes to renegotiation every year also means that realized wage data is lagging a lot recent developments. But if you look at the wage sort of settlements that are included in the recently concluded contracts, that is clearly going up. At the same time, that doesn't constitute a wage price spiral. That constitutes a one-off adjustment in wages. And we do believe that there is room for such a one-off adjustment in wages. If you also realize that corporate profit margins are still, well, at a record high, or at least historically very, very high. Coming out of the corona, I think the corporate sector has fared much, much, much better than was feared beforehand. Also in part due, of course, to the fiscal support measures that were taken, that were very successful. But at the same time, that gives me a certain degree of comfort that even if I'm seeing much higher wage agreements in the month forward, and also let us remind that in the euro area, the most important wage settlements are done in the fall. So the second half of the year is much more important than the first half of the year in this context. Even if I were to see significantly higher wage settlements, that would not automatically trigger already a wage price spiral. But of course, another indicator that I have to look at is inflation expectations. They are still under control in the sense that there is no broad-based de-anchoring of inflation expectations in the euro area. But some indicators are beginning to approach, let me put it, the brink or the frontier of the space in which I can still say that there is no de-anchoring. If you look at, for instance, at the survey indicators, they are moving up. The 5-year ahead inflation expectation, 2.1, 2.2. The value in and of itself is not worrisome, but of course the development is a little bit more worrisome. If you look at consumers and firms expectations, they are much higher actually than 2%. There is always the question, how relevant are they really? But for consumers, the psychology is very important. You don't want consumers in their psychology to move from a low inflation regime to a high inflation regime. Rational attentiveness versus rational inattentiveness is quite important to keep expectations at bay. So there we have to absolutely remain vigilant, follow the data closely, because that would be a possible deterioration of our inflation problem if that were to happen. We're not seeing it yet, but it requires, I think, close monitoring.
Do you have a rule of thumb on how much wages can increase without you being unduly worried?
Well, I think if you have a 2% inflation target and you have a sort of long-term productivity growth of 1%, then of course 3% is a sort of natural benchmark for wages that in the long run, and that is consistent with the 2% inflation target. Of course, now you have this big sort of one-off effects because of energy price inflation. Europe has suffered a significant terms of trade loss around 4 or 5% of euro area GDP. That is a loss for the area. I mean, that cannot be fully compensated. So we can sort of spend a lot of time and futile energy by trying to shift that burden onto from workers to employers to the government, etc. But I think we somehow have to accept that loss. So I clearly would never accept headline inflation to be a good starting point for wage negotiations. Some trade unions are trying that, but I think that is outrageous. But that being said, if you look at core inflation, you strip out energy, it's also running at almost 5% in the euro area. And there is, of course, a slightly stronger case for trade unions to focus on at least being compensated for core inflation. Now, as a one-off, I wouldn't immediately say, again, that would trigger concerns about wage price spirals. But we cannot continue to have these wage settlements, because then at some point, I think the entrepreneurs will also not have no choice, the producers will have no choice but to increase their producer prices. And then that risk becomes much more manifest again.
Good. Yeah, that was very clear. Another question. The ECB introduced a transmission protection instrument in July to deal with fragmentation risks. Under what circumstances do you envisage making use of this tool? How can the ECB separate between a tightening of financial condition that is driven by country fundamentals and those that are driven by unwarranted, disorderly market dynamics?
Yeah, Alfred, this is a question that I'm also posed a little bit more often. And then I'll also begin to say that in central banking, there is some value in constructive ambiguity. That being so, I'm not going to be fully precise on the precise conditions under which what instrument can be triggered and to what extent, etc. But of course, what I would say is that the euro area is prone to financial fragmentation. There's absolutely no denying. So in the meantime, within the European Central Bank, we have developed what I would call a richly filled toolbox to deal with fragmentation contingencies. We have the flexibility in the PEP reinvestments, and if and when we start to roll off our asset purchases, we will probably begin with the monetary stance only asset purchase portfolio and keep PEP reinvestments as we promised at least until the end of 2024. So that will be with us for quite some time, including this built-in feature of flexibility with respect to reinvestments. We have the transmission protection instruments, newly created, newly developed, and also we still have the OMT from 2012. When and under what circumstance and which of these three instruments will be triggered is very difficult to say beforehand, because each contingency is always different than the one you experienced in the past. But rest assured, we have this richly filled toolbox. If there is a contingency that doesn't precisely fit one of these three, we will come up with a combination or with something else, because we do understand that managing financial fragmentation is absolutely necessary for us to be able to deliver on our price stability mandate. Because if fragmentation issues were to get out of hand, they would also become deflationary, as we have seen in the euro area debt crisis about 10 years ago, etc. So where the boundary lies between warranted and unwarranted fragmentation, that's of course the million-dollar question. I could say that's not only dependent on the level of spreads, but it's clearly dependent on the dynamics in the spread. When you see one of these self-fulfilling destructive spirals developing, very quick movements in just a matter of a few days. So the delta in spreads is probably even more important than the level in spreads. But it will always require a sound dose of judgment. And again, that's what we are being paid for.
Good. You already alluded to the fiscal stance. Many governments in Europe have increased spending to cushion the impact of higher energy prices. How is this impacting the effectiveness of ECB monetary policy? In your view, how can fiscal policy help monetary policy more forcefully tame inflation?
Well, we have given, I think, a number of hints how we believe that fiscal policy can help monetary policy. Targeted, temporary, tailored, funded. These are the kinds of words that come to mind. Now, I'm not sure whether some of the fiscal packages that we've seen recently comply with these four principles that I just laid out. So, but let me begin by saying that we also at the table in Frankfurt, we're a bunch of technocrats, but we fully understand the need for governments to compensate their citizens for this unprecedented hit to purchasing power that is coming from this spike in gas and other and related energy prices. So there is no discussion that this is the role that you expect fiscal policy to play to support the purchasing power of the most vulnerable citizens in society. Unfortunately, what we are seeing is that most of the packages that are being presented, they are not very targeted, they're relatively broad. You can debate whether they are truly temporary. They are being presented as being temporary, but it's not so difficult to find an energy specialist that will tell you that gas and energy prices will probably be elevated for many, many, many years before this gap that is now, this hole that is now created by cutting off Russian gas, the supply of Russian gas that needs to be substituted by something else. That substitution is not something that you can do very quickly. So if energy prices continue to be elevated for many years, how temporary is the fiscal support measure? I mean, fast forward a year from now, do we really believe that if the purchasing power looks as terrible a year from now than today, that then the government will say, yeah, well, it was temporary, so we'll discontinue it now? I don't think so. There is a huge risk that this is actually an open-ended arrangement that has been sort of woven into our fiscal policies that will not come to an end, and that has a very uncertain also fiscal cost that is dependent in part also on the development in energy prices that are very difficult to predict. And a lot of it is debt financed. Mm-hmm. And if these expenditures are financed by debt, then it provides for a net fiscal impulse into our economy. But an economy that is already overheating, that is already suffering from high inflation. And high inflation is there because you have more demand than supply, regardless of whether that is coming from very fast growth in demand or negative developments in supply. There is the imbalance, and that imbalance is being enlarged by a net fiscal impulse. So what the governments at this moment are doing, there's a big risk that we will identify fiscal policy as the major upside risk to our inflation path, and therefore a reason for us to tighten monetary policy even further than we already would have to do otherwise.
And that would be extremely counterproductive.
And that would be extremely counterproductive, absolutely.
Good. Audience, I think that was a fascinating discussion with very clear and sharp answer by Klaas. Any questions from your side? Yes, please.
Good morning. Thank you very much for the very illuminating conversation. I'm from Bank ABC. I'm an economist in the Middle East. My question is, do you use Taylor rule type of models? And I mean, I don't normally look at the euro area inflation and so on, but when I look at the numbers, it shocked me, frankly. I mean, it was triple where what you're suggesting you would stop in terms of the policy rate. Thank you.
Well, I think we are in an unprecedented period, and any model or quantitative rule simply suffers from the fact that it has probably been calibrated at a time and at a sort of data sample in which there was no pandemic, there was no Russian invasion into Ukraine, war on the European continent, and what have you. So I think, of course, we look at all these metrics, including simple Taylor rules, and you can also play around a little bit with the assumption in these rules. Yes, we have our own model projections, and they are as good as the ones of the IMF and other institutions, but they also suffer from the fact that they are not a very reliable guidepost at this very moment, because by construction they cannot be. These shocks are so unprecedented that at the time of this, I do believe that monetary policy is a little bit more an art than a science. And that provides a natural limitation to these sort of estimates.
Thank you for your insights. I'm with the IMF. There are now growing calls to move inflation targeting regime from 2% to 4%. to avoid, zero lower bound in the future and
Yeah.
deal with crisis in the future better. What do you think about that idea?
Well,
Thank
I'm
you.
not overly enthusiastic, let me put it like this. First of all, I think the timing of it could not be worse. If you increase your target at a time in which you are so far above your target, I think it destroys a lot of credibility. But secondly, there's a more, I think, also fundamental argument against it. I believe that sort of delivering on a price stability mandate has a lot to do with rational attentiveness versus rational inattentiveness. So when is there inflation? When people talk about inflation, when people are aware of inflation. Now, where does the boundary lie between rational inattentiveness and rational attentiveness? My hunch is, and there's actually some research also, I think, supporting this claim, is that it is at most at 2%. And that if you were to have a regime with a structurally higher inflation rate, the risk that you get all these things like automatic price compensation, all these investment in hedging strategies, etc., the things that we got so painstakingly rid of after the inflation of the 70s and the 80s, that these come back with a vengeance, I think that risk is very high. And then you would reintroduce real wage rigidity, which would make future adjustment processes much more painful. So I tend to err on the side of caution here. Not only would it be terrible timing to contemplate such a move, I also think that fundamentally building a regime on structurally higher inflation rates has some severe costs in terms of sacrifice ratios, etc.
Mm-hmm. Do we have any questions on this side? No? Then we continue here. Front row, please.
Thank you very much. Rick O'Sullivan, Change Management Solutions. There's a lot of growing criticism of pressures being put on central banks to promote green policies and increase economic access for women and minorities as being undermining the major objectives of the bank and possibly be counterproductive. Could you comment on that criticism?
Yeah, I can comment in general, but I can also make a very specific observation on the current situation that we are in. First, in general, I do believe that climate change and the energy transition that our economies will have to undergo will be one of the major forces of structural change in our economy, of structural adjustment in our economy, and therefore is absolutely relevant for central bankers because it will affect us in all the roles we play. It will fundamentally impact on the inflation process, where we are in a supervising capacity. It will change the nature of financial risks, the nature of credit risks in portfolios on our own balance sheet. Our investment policies will have to green with sort of the change in the overall economy. So I think it's perfectly legitimate for central banks to be involved in this discussion because it does affect our primary mandate, price stability, and it also affects our secondary mandate, which in the case of the ECB is that we have to support, actively support the policies of the European Union as long as they are not conflicting with our primary mandate of achieving price stability. So that's the conceptual part. But then let's move back for a moment the discussion we had on whether or not governments should compensate for the loss in purchasing power because of the high energy prices. Why am I afraid that this will not be temporary support, and why am I afraid that this will have inflationary consequences? Because, of course, these policies do nothing about the underlying problem. And the underlying problem is that our economies are way too dependent on fossil fuels. So here you have a concrete example where we as central bankers should not only point at the risks of having these fiscal slippages over a longer period of time, but we should also stand up and say, but governments, aside from supporting your citizens, you should also intensify your efforts to really get out of fossil fuels and move towards renewables, because that is the only sustainable solution to the current problem we have with high energy prices and the death of gas resources.
Thanks. And we have one last question.
Thank you, Mr. Governor. Luboš Komárek from the Czech National Bank. What is your view on the optimal monetary policy horizon? You know, because as you described, you know, now we have the situation of the positive demand shock and negative supply shock, and we also had this discussion in the Czech National Bank. But please, thank you.
Well, that's a very complicated question, because I do think that it depends, of course, on monetary transmission and what you think is the way that monetary policy transmits to the real economy. I mean, with the financialization, let's say, of our economies, with the huge importance of housing wealth and housing markets, it may well be that the transmission of monetary policy has become a little bit faster than used to be the case in the past, because markets immediately respond, immediately try to price future developments. Housing markets respond quite directly to changes in mortgage borrowing costs and what have you. So on the one hand, you could say maybe transmission lags have become a little bit shorter than they used to be in the past. At the same time, of course, with the negative supply shock, there is always an argument, be patient, because you don't know what part of it is a one-off. Well, initially, when we had the first sort of round of negative supply shocks, let's say mid-2021, indeed, there was this argument, is it not transitory? Should we not be patient? Should we perhaps not look through? At this very moment in time, we've had such a sequence of negative supply shocks that already the risk of inflation becoming more persistent than we like, and therefore the continuously elevated risk of actually de-anchoring inflation expectations is uncomfortable. So we cannot afford to take this longer horizon simply because it has already lasted for too long. But I think a lot of academic research should still go into these questions. It will, by the way, in a heterogeneous area like the euro area, it might also differ from one part of the euro area to another part. And where the Czech Republic is on this, it depends on whether your mortgages are variable rate or fixed rate. I don't have that on the top of my mind. But these kinds of sort of structural financial elements that also come into play then.
Fantastic. So we are ending on closing. That was the last question. Closing the loop. You went for the big picture. You went for the specific. You went for the technical questions, and you were always very clear and to the point. Fantastic. Thank you very much. And please, a big round of applause for Klaas.
It was my pleasure. Thank you.